Hey there, and welcome. So, if the words debit and credit have ever just made your head spin, trust me, you are in exactly the right place. We are going to break this down once and for all today, and I promise you, it's going to be the simplest explanation you've ever heard. Let's just dive right in. Okay, first things first, let's just wipe this slate completely clean. Forget whatever you thought you knew. The biggest mistake people make is thinking debit means plus and credit means minus. That is just not true. Their effect, whether they increase or decrease something, totally depends on the type of account we're talking about. This is the most important idea, so let's really let that one sink in.
So, what do they mean then? Well, it's almost shockingly simple. Debit just means left, and credit just means right. That's it. Seriously. Think about an old accounting ledger book, right? It's got a left column and a right column. Debit is the left side, credit is the right side. We're literally just deciding which column to put a number in.
Now, the big question, how do we decide if we use the left column or the right column? Well, that all comes down to which one of the 5 core account types we're dealing with. And these 5 accounts, they are the absolute foundation, the building blocks of all accounting.
And here they are. Every single transaction a business could possibly make is going to touch at least 2 of these 5 accounts. You've got assets, which are basically things you own, liabilities, which are things you owe, equity, that's the owner's stake in the company, revenue, the best part, the money you earn, and of course, expenses, the money you got to spend to keep the lights on.
All right, so we've got our 5 accounts. Now we need the rules of the road, the rules that tell us how they all interact. This, my friends, is where the magic really happens. Let's see how this whole thing connects.
This right here, this is what I call the golden table. If you can understand this one slide, you've pretty much mastered the fundamentals. Just look at the pattern. To make assets and expenses go up, you use a debit, the left side. But to make liabilities, equity, and revenue go up, you use a credit, the right side. So the key takeaway is that the same action, increase, is recorded in totally different ways depending on the account type. That's the whole secret.
Theory is great and all, but seeing this stuff in action is where the light bulb really goes on. So let's run through a few super simple, everyday examples and see how these rules actually apply in the real world. Okay, first up, you go out and buy a new laptop for your business and you pay for it with cash. Pretty straightforward, right? We have 2 things happening here. You're getting an awesome new laptop, but you're giving away some of your cash. So let's break this down. The laptop and the cash are both assets, right? Your laptop asset is increasing, it's going up. And we know from our golden table that assets increase with a debit. So boom, we put laptop in the left column. But at the exact same time, your cash asset is decreasing. And how do assets decrease? With a credit. So we put cash in the right column. See that? Perfectly balanced. All right, next up, your business needs a little cash injection. So you go and get a loan from the bank. The bank hands you a pile of cash, and in return, you now have a debt that you have to repay. Now this example is perfect for showing why this can seem tricky. Your cash, which is an asset, is increasing, so of course you debit it. But what's the other side of that? Well, you've created a loan payable, which is a liability. Your liabilities have also increased, and how do we increase a liability? With a credit. So get this, both sides of this transaction are an increase, but one is a debit and the other is a credit. It all makes sense now, right? Okay, let's do a happy one. You finished some work for a client and they pay you in cash. This is the lifeblood of any business, right? Getting paid. Pretty simple, huh? Your cash, which is an asset, goes up, so that's a debit. At the same time, your revenue has gone up, and we know from our table that revenue increases with a credit. So you debit cash, you credit revenue, and you're done. All right, our final example. It's the end of the month and the landlord's knocking. You have to pay rent for your office space. You're spending cash on a totally necessary business expense. So what happens here? Well, you've created a rent expense, and expenses, just like assets, increase with a debit. So you debit the rent expense. And how'd you pay? With cash. Your cash asset has decreased, and we know assets decrease with a credit. See? It doesn't matter what the transaction is. Every single one follows these exact same simple rules. So you've seen the rules, you've seen the examples, but you might be sitting there thinking, okay, how on earth am I supposed to remember all of that? Don't even worry, I've got you covered. Let's get to the final piece of the puzzle that is going to lock this in for you forever. Exactly. Who wants to carry that golden table around in their pocket? It's just not practical. You need a tool, something you can use anytime, anywhere, right inside your own head.
And here it is. I'll admit, it sounds a little strange, but I guarantee you will never, ever forget it. We're going to use a little mnemonic called DEAD CLIC. Let's start with the first half, DEAD. This stands for debit, expenses, assets, and drawings. And drawings are just when an owner takes money out. It's a type of equity account. The rule is just so simple. All of these accounts increase with a debit. If you can remember DEAD, you've already memorized half the rules.
And what about the other half of the equation? Well, that's CLIC. This stands for credit, liabilities, income, which is just another word for revenue, and capital, which is another word for equity. And all of these accounts, they increase with a credit. So let's put it all together, right here, nice and simple. The accounts that increase with a debit are your expenses, assets, and drawings. DEAD. The accounts that increase with a credit are your liabilities, income, and capital. CLIC. That is it. That is the entire system of debits and credits in 2 little words. And honestly, that's the key. Once you know that debit means left, credit means right, and you've got that DEAC rule in your back pocket, the whole world of accounting just opens up. You're not just memorizing rules anymore, you're actually understanding how it works. And with that understanding, you really are unstoppable.